So you want to learn more about monetary policy? Well, you're in luck because this video is just for you. What we're going to look at here is part 4 of our exploration of the implementation of monetary policy. That's a lot of words. So in previous videos, you can see the playlist in your top right corner of your screen. If you want to go and check out some of these videos, I highly recommend it. What we're going to look at today is step 5, which involves the stances of monetary policy. In terms of monetary policy, let's make this simple. There are 3 stances. There can be a stance of tightening monetary policy or contractionary stance of monetary policy. This is where the RBA is increasing the cash rate, aiming to increase overall interest rates. So that is when the RBA tightens monetary policy or has a contractionary stance. We can also look at where the RBA loosens monetary policy, and this is where it has an expansionary stance of monetary policy. What's happening here is the RBA is reducing the cash rate, aiming to reduce overall interest rates in the economy. So that's an expansionary stance of monetary policy. The final one is there can be a neutral monetary policy stance where the cash rate is kept at its same level. What I'd suggest you do is you pause the video, take down this table and give it a go yourself. Then replay the video and I will give you some suggestions on what should go in this box. Okay, let's start with the monetary policy stance over here of a contractionary stance. So here the RBA is trying to increase. So in terms of DMO, that what the RBA is going to do, that the RBA will sell CGSs to the commercial banks, and what this is going to do, I should really put this over here, is that what it's going to do is this will reduce money supply, which will then result in a higher cash rate. It might be useful for you to go back and try, and you can see a link to a video in the top right corner that can help you with drawing the graphs. If we have a higher cash rate, now remember it's going to be more expensive for banks to borrow. Their costs are going to go up. So what they're going to do is they're going to increase interest rates in the overall economy. And that what we'll see in future videos is what impact that will have on the economy. Let's flip the script. Let's look at expansionary stance, which will result in a lower cash rate. So if the RBA is going to try and reduce the cash rate, the RBA will buy back Commonwealth government securities from the banks. If it buys something from the banks, it's going to give them some extra money, higher money supply, reduce the cash rate, and this will allow banks to reduce their level of interest rate. So remember, in terms of stances, we can have a contractionary stance where the RBA tightens monetary policy, an expansionary stance where the RBA loosens monetary policy, or just a plain old neutral stance.